This Development Finance Today filmed roundtable event in association with Watson, Farley and Williams will feature a discussion on which areas of the property development market are currently underserved and where the most opportunity lies. John Carter, Commercial Director of Commercial Real Estate at Aldermore, and Simon Whitfield, Head of Development Finance at Castle Trust, will be joined by Ranjiv Kumar, Partner at Watson, Farley and Williams. Also in attendance is Donna Downey, Senior Commercial Manager at Watts Commercial Finance, Edward Clark, Advisor at Uplift Finance, and Giulio D'Andrea, Marketing Director at Green Life Buildings Ltd.
You know, anything with an eco-friendly, carbon neutral tint has been historically not very easy to fund, for good reason, because the costs have been high and it's debatable as to whether you actually will recoup those costs in the end GDV. I think over the next 10 years that trend will change, because millennials like myself are going to get older and richer, and at the moment they haven't really got any money. But in 10 years' time they will, and those consumers will value that, and I think will want to pay. And there's also an economy of scale that's going to kick in, is once we have these sort of modular building firms like yourself who are able to produce passive house standard to a square metre price that's probably equivalent to a traditional build, it's going to become a no-brainer. But you know, people are tentatively having a look.
I think there's a lot of lenders who won't touch it.
Yeah, there are a lot of lenders who won't.
I think it's a lot of them are scared by the product, scared by the complexities, and they prefer to finance anything that just looks a bit more normal.
They don't understand the structural integrity of most of these systems, and that's the problem. Most of the lenders I talk to, the first thing they want me to do is, can you talk to my QS? If he's happy with it, we'll look at it. And 9 times out of the 10, the QS doesn't even read the paperwork. He just goes, does it tick building control regs? Yes, it does. What's your problem? And that's the sort of, if that's what we're coming across with a lot of our lenders. But even still, we have all the warranties in place. You can have BOPAS in place. You can have LABC in place. We've got Premier Guarantee for our system. Even still, lenders will look at that and go, I'm still not sure.
I'm not wanting to use the B word, but somebody's going to have to.
Yes. Of course.
You know, we've got an eco scheme at the moment that it's had a couple of issues, but that. You know, and I can only imagine that's going to get worse because they're sourcing all of their staff from Europe.
Yes, and you're absolutely right.
You know, that takes so long, and there's the lead times for some of the products, notwithstanding the fact that they're allegedly reasonable, just makes the build go on and on and on.
And that is the issue. There are a handful of off-site modular builders who source all their materials outside of the UK, and that is definitely a big issue, lenders. But at the same respect, there are at least there's probably about enough to match them who do actually manufacture in the UK and source all their stuff out the UK. And they still, and I think sometimes, and you're absolutely right, Brexit is an issue, but so I think in one respect, lenders are using it as an issue to say, let's just play the Brexit card at this stage and play it safe.
Donna, what asset classes do you find that you struggle to arrange finance for?
I suppose retirement living is something that is still a bit of a challenge. I mean, there are more lenders who understand it, and you know, it's just that there's quite a few routes to market in terms of sales, and I think that's going to change. It's going to have to change, obviously, with the population being as it is, and modular will probably be forming part of that market anyway going forward. But in terms of, you know, my developers that I'm working with at the moment, they want to have a division, a retirement living division, and there are different, working with local authorities who will, you know, there won't be just a straight sale. And, you know, we're not talking PRS or anything like that here. We're talking about, you know, different sales strategies, shared ownership, and local authority taking part of a development as well. I
think retirement living and retirement schemes are going to be absolutely massive. I think they're a big growth area, and I think if you're a lender that's not dealing with that, you're not going to survive.
The difference with Australia, US, New Zealand, South Africa, where these are really established models, is they've got loads of land. We haven't. The sales profile for those that are aged either over 55, over 65, and I've seen some restricted to over 75 as well.
Really?
Yeah, so that's some of the planning that you can see. which is fine, because I agree there's definitely the age demographics say that's okay. However, what we're forgetting, those people can choose to just buy a property that's not got a restriction. They don't have to buy that. So what it is it's a trigger in terms of someone's lifestyle to drive towards wanting to buy that. They are slower to sell. They always have been.
Absolutely.
But they sell at a premium.
Yeah.
But they need an operating and underlying strong residential market for someone to monetize a home in order to then buy. So they downsize into that. So that's the profile.
You know, with assisted living and supported living, there are a number of RPs out there who will do a very good job, but you could probably count them on the fingers of one hand, to be fair. And I think that's where lawyers also come in, because we can help to streamline the transaction, to maybe take some of the complexity out of it, put together documentation which you might not originally think is appropriate, but actually, for example, with an assisted living transaction, we've put it together something that resembles a term facility with a revolver aspect, where the borrower can dip in and dip out when they find a property and so on. So there are things that you can do to soften the edges, but I think initially the lender has to have a lot of buy-in into a particular area, and even though they might be interested, that doesn't mean they're going to lend into it.
We ran a poll in DFT in September, and 83% of respondents said that there weren't enough funding options for projects where there was perceived higher reputational risk. There are other assets as well which you might shy away from.
I think it's those sectors which have some sort of social aspect, whether it's nurseries, retirement homes, assisted living schemes and so on. I think where there are other stakeholders, that's where the reputational risk can come in.
At which point in the future will carbon-heavy developments become a reputational risk in themselves? With all the movement with Extinction Rebellion and all the rest recently, at the moment, it's not too much, let's be frank, but once the standard of competition raises in that space, and if you're tied into a scheme that's being built in stages over a number of years, what are the odds that in the middle of that scheme there's a bit of a sea change in culture?
That corporate social responsibility piece, I think, is something that certainly as a lender, I know we're aware of it, because it's part of the environment that you're in. So I agree. It comes back to the viability issue again at the end as well.
Will you make an assessment on that for new cases that are coming to you?
Absolutely.
It'll be priced in on it.
Absolutely, because that to the point of the discussion we're making, that's a reputational risk that comes back on us. And the other one that probably to add to that, I was just going to say, was the slum landlords element piece as well. And there's been a fair bit of stuff in the press recently about that, and being associated with that again has, I think, big reputational issues in terms of assisting people to provide poor accommodation.
It will be market driven to a certain extent, though, won't it? Because obviously people are more discerning now, and quality needs to be quite high in HMOs. You see that a lot now, and at the end of the day, the lender's got the choice whether to post valuation, whether to that's the right quality for us, that's the asset class we want. So it will be market driven, I believe.
Yeah, absolutely. And now we've got the no fossil fuels in new builds by 2025, then naturally heating bills will just start to go up if it's all electric. So people are going to be quite conscious of that. So they're going to be looking for buildings built out of a building fabric which eliminates their fuel costs.
From a broker perspective, I want to work with a lender who's going to offer the right term, for that product, and look at, geographically, again, location-wise, there's different areas are selling at different rates, and somebody who's going to, ask the right questions, but also sort of, you want something reasonable. You're not going to just throw a 24-month facility in because that's the maximum facility. You want somebody, if it is going to work on a phasing basis, maybe look at a revolving facility, look at something a bit more off-field, and just have a look and see whether it's the right deal for the client.
And it gets back to what's your borrower strategy, what's the realistic timescales, which we discussed earlier on, and then assigning a facility that actually meets the borrower's strategy and needs.
And will your developer strategy change? Because it often changes.
And priced appropriately
three
as well.
times during the development.
And priced appropriately. And to your point, it gets back to, it's not about price then, it really is about, it needs to be reasonable, but it's about being able to deliver on that strategy and
I
work
guess
with
these
someone.
questions just need to be asked at the beginning, like from a broker perspective. If we need to extend, will you have funding available to be able to do that? Because it's probably likely in this type of market.
And do I trust the answer you've given me as well?
Yeah.
And
What's the track
how do you
record?
de-risk for the client? That's the issue.
And that's
You
it.
know,
Or
how
would
do you
I even be
de-risk?
confident asking that question? Because would it put the lender off if they suddenly get a hint that you may come back to me and ask for more money? Where I think the real sort of opportunity is at the minute is the sort of middle ground between panelized systems that still need to be built off-site, which a lot of the big developers like your L&Qs are shying away from because they want the volumetric model. But in one respect, they're missing a trick because you've got these panelized systems that everything's built on site. It will cut the build time down by 50% than traditional on average. And actually, it will reduce the build cost. One of the main reasons we focused on Tunbridge Wells is because traditionally built houses, you're lucky to find a local developer. You're lucky if you can build a house between £1,700 to £2,000 a square metre. We're building at £1,250 a square metre. So for an SME developer who's suddenly brought all this land over the last 5 years and is now going, oh no, we can't deliver on any of this because our build costs are way high. They're coming to us now saying, actually, we have to form a partnership with you because otherwise we just need to sell all this land and move on.
Are the skills needed for MMC different to a traditional, or can you have less workers?
It's not even that you can have less workers, you can just actually have less skilled workers. Because a lot of these systems are almost like Lego sets and they're built in that way where they're made easy to put together quicker on site. So when you've got systems that require that less level of skill and less manpower on site, that's what will be the market force that drives this.
I think a bit of risk analysis actually, not just of that deal but of the portfolio. It's, the lender's very incentivized to be careful of their exposure. I think it's important to make sure you've got a client who's going to be liquid if his void period's double.
The enduring feeling afterwards is not how the transaction started, because it clearly would have started well, I suppose, but actually how it ended and how painful it was. And actually it's that resonates when when the lenders and the sponsors are looking at the next deal, because they think, oh, we did that care home transaction or the assisted living transaction. God, it was difficult. It took forever to do. We probably wouldn't do another one quickly. So I think it's incumbent on all professionals to actually streamline the process, consolidate the documents, speak clearly, and deliver on time and on budget if they can. But I think it all goes back to experience, that this is not a market for inexperienced lawyers and other professionals.
Thank you for watching our latest filmed Roundtable event. If you would like to attend or sponsor one of our future events, please get in touch at beth@medianet.co.uk. We are holding events next year in February, April, May, September and October. So if you want to be involved, please do get in touch.